Hi everybody, it's FIBO Group, and you are watching to the Market Watch Review. Next week will be the last major week of the year. 5 central banks and 9 emerging market countries are expected to attend. Norges Bank in Norway is the central bank most likely to raise its deposit rate. It will do so on December 16. This would be the second increase of the year. It would be the second hike of the year. The headline inflation rate rose to 4.6% in November, which is the fastest pace since 2008. The base effect, which Norway adjusts to tax changes and excludes energy from the underlying rate, seems to have reached its bottom. It warns that there will be more upside pressure in the coming months. The unemployment rate dropped to 2.1% in the last month, which was pre-COVID. The Bank of England was in action. However, the idea that the December 16th meeting was fading, particularly after the announcement of Plan B, a plan to resume work from home and a new COVID variant. The market was actually downgrading the odds since the November BOE meeting. The implied yield at December futures was 9.5 BP. This is its lowest level since March. It almost priced out a hike right now. The Bank of Japan meeting on December 17th may be the closest thing to an event. There is little to do. It revised its forecasts in October. It recalls that it reduced this year's growth forecast from 3.8% to 3.4% and moved half of the cut into next year's, revising its projection from 2.7% to 2.9%. The forecast for the next fiscal year was left unchanged at 1.3%. CPI was flattened from 0.6% in this fiscal year. The next year and the subsequent year were the same at 0.9%, 1.0%, respectively. FOMC and ECB, that brings me to the two most important and influential central banks. The Fed, December 15th, and the ECB, December 16th. The Fed's tapering pace is the main focus. The Fed must normalize its balance sheet if it wants to stop expanding after the economic crisis is over. Omicron's emergence has not made the economic crisis any less severe. The implied yield for the December 2022 Fed Funds futures contract has increased by approximately 50 bps to 2 rate increases, with a 6 to 6% chance that there will be a third. The Fed has let the market do the heavy lifting and the market will catch up. The Fed officials may have raised their dots by 25 bp, so that the Fed hawks now consider 3 hikes necessary. Those expecting one could see 2. 9 Fed officials have estimated the long-term equilibrium Fed funds rates at 2.50%. 2 Fed officials are at 3.0% and 1 at 2%. 5 officials are at between 2.25% and 2.375%. 1 did not place their bet. This is not what the market expects. The ECB is a completely different breed of fish. The ECB leadership is less concerned about inflation than its American counterparts. According to a recent BS report, inflation in the Eurozone would be closer at 1.5% if there were no supply chain disruptions, compared with 2.5% for the US. That's all for me. Closely monitor the news background and be prepared for all the surprises of the market.